As I say, volatility is vitality. Bitcoin is a volatile asset. If you're going to hold the asset, you need a 4-year time horizon as minimum. A 10-year time horizon is really the right time frame. If your time horizon is less than 4 years, you should hold the credit instruments like digital credit. And if you're an equity investor in a digital equity like my company, you need that same 4 to 10-year time horizon. 4 is the short term, 10 years is the long term. I'm an officer of a publicly traded company. And what are we doing? We are in the business of buying a high energy, highly volatile asset and stripping the risk and the volatility off of it in order to sell it to people that are much more risk adverse, that are much more volatility adverse, that just want that yield. And so if Bitcoin wasn't volatile, it probably wouldn't be high performance. And then our value added wouldn't be that great, right? Like, for example, I say to people, if you knew Bitcoin was going to go up 2% a month forever with no volatility.
Bitcoin has undergone significant fluctuations this November, declining toward $80,000 after reaching a peak of $126,000 in October, accompanied by a death cross pattern and modest selling activity contributing to the downturn. Support levels range from approximately $78,000 to $84,000. However, analysts identify potential for a rebound to over $100,000, driven by seasonal Moonvember trends that have historically resulted in increases of 10 to 40%. Alongside ETF inflows and expectations of Federal Reserve rate cuts, with forecasts rising between 30 and 80% for December, geopolitical tensions and tariffs exert additional pressure. However, long-term holders possess 76% of the supply and are targeting a year-end value of $165,000. Should the critical resistance level be surpassed, Michael Saylor, in a recent interview, described Bitcoin's volatility as its fundamental strength, a vital characteristic that requires perseverance. He recommended a minimum holding period of 4 years, with 10 years being preferable for direct ownership, cautioning that lesser durations are more appropriate for credit instruments such as digital credit. Equity investors in companies associated with Bitcoin, he noted, must adopt the same long-term perspective to withstand fluctuations. Meanwhile, Tom Lee attributed the market difficulties to uncertain monetary policy, noting that the likelihood of a rate cut in December has varied significantly from 60% to 30% and then back to 80%. He additionally emphasized the unpredictability of policies resulting from administrative statements, which frequently involve deceiving signals that unsettle investors and obscure strategic direction. Please view the interview video for further insights into Michael Saylor's most recent analysis. Please kindly like this video, subscribe to the channel, and enable post notifications to receive future updates. Thank you for your attention. Please enjoy the remainder of the video.
As I say, volatility is vitality. Bitcoin is a volatile asset. If you're going to hold the asset, you need a 4-year time horizon as minimum. A 10-year time horizon is really the right time frame. If your time horizon is less than 4 years, you should hold the credit instruments like digital credit. And if you're an equity investor in a digital equity like my company, you need that same 4 to 10-year time horizon. 4 is the short term, 10 years is the long term. I'm an officer of a publicly traded company. And what are we doing? We are in the business of buying a high energy, highly volatile asset and stripping the risk and the volatility off of it in order to sell it to people that are much more risk adverse, that are much more volatility adverse, that just want that yield. And so if Bitcoin wasn't volatile, it probably wouldn't be high performance. And then our value added wouldn't be that great, right? Like, for example, I say to people, if you knew Bitcoin was going to go up 2% a month forever with no volatility, neither you nor I would be in business, because all the conventional finance investors, all the conventional journalists, they would dominate the market. Warren Buffett would own all of it, and there wouldn't be an opportunity for us. So I look at the volatility as it's a challenge, but it's also the bug is the feature. And I say to people, volatility is Satoshi's gift to the faithful. he basically gave you the ability to rise to the top of your profession as an analyst, as a journalist, as a corporate operator, as an investor. And if the volatility goes away, no one cares about your opinion on any of this. It's like, you've got fire, and we've got the phrase burned. Fire burns you and electricity shocks you. And Henry Ford created an automobile, with a burning engine, with a fire in the engine. And we created electronic transmissions. And so you put electricity and fire in the car, and you've got a killer consumer product. And I think the key here is you got to look at this market and say, this is indicative of energy. You can harness the energy. You can't be scared of the energy, right? There are those people that run from the fires, and then there's people that put the fire in the automobile or the jet airplane. And we kind of need the people to build the airplanes and build the automobiles if we're going to move the civilization forward. So the volatility comes with the territory. And you don't want to take any counterparty risk to a currency, a country, a company, a culture, a competitor. Then you buy Bitcoin. And if you're an equity investor, and if you want amplified exposure, if you want to invest in the future of digital capital and the future of digital credit, and you're enthusiastic about, like, we think we can sell a treasury credit product that's really compelling and very interesting to 1 billion people, right? 1 billion people would love to have a bank account that pays 10%. If you would like to invest in that future as an equity investor, and you don't need the money for 4 years or longer, then you can hold the equity. If you need the capital in the next 4 years, then you probably want to be a more risk-averse investor. You need to look at a credit instrument. And if you need exactly down to the penny, $87.17 in 2 weeks, you probably want to put your money in a bank or a money market, because that's just what you need. And so I think every investor has to decide what's their risk tolerance, what's their time frame, and are you a credit investor, are you a capital investor, or are you an equity investor? And then once you've made that decision, you can decide how to allocate obligation. And the dividend obligation works out to about $2 million a day. $2 million a day works out to 5 basis points of our trading liquidity. So let's say if the stock is trading above 1 times MNAV, then you're talking about a 20th of 1%. It's like nothing. But let's go to the situation where the stock falls below 1 times MNAV, and we don't want to sell the equity. We can either sell the commodity, Bitcoin, or we can sell derivatives on the commodity, or we may even sell derivatives on the equity. But let's put that in perspective. Bitcoin's trading $100 billion a day. $2 million works out to, it's like 2/100ths. No, actually, it works out to 1/5 of 1 basis point of all the trading of Bitcoin each day. It's like, it's not 1% of 1%. It's 1/5 of 1%. It's so small that it would pop up in the 5th significant digit, as a rounding error. So the company's dividend obligations are fairly de minimis. You can literally calculate them on our website. I think if Bitcoin goes up 140 basis points a year, we can pay the dividends forever and generate shareholder value, right? It's that small. And if Bitcoin goes up 0% a year, we have capital for the next 70 years. And in 70 years, we'll have to figure out to do something different. And we'll figure out what we're going to do to deal with it. But the company's financially very, very strong. And we have a huge number of financial options at our disposal because we are an operating company, and any of them could be used if we need. I also think it's already priced into the market by a factor of 10, if you count it. I don't think there's any relationship between the decision-making of MSCI and the NASDAQ 100 or the S&P 500 index allocators. The company is an operating company. It's just like insurance companies use capital in order to create financial products, and banks use capital to create financial products. We use capital to create digital credit finance products. It's possible there are people in the world that don't fully appreciate digital credit or digital treasuries. That wouldn't surprise me. We had that challenge with bankers that didn't want to bank Bitcoin. We had that challenge with accountants that were a little bit skeptical of digital assets accounting. The accountants embraced the asset, the bankers embraced the asset, the politicians embraced the asset. We had the challenge with credit rating agencies, and they just embraced the asset. We're starting to get credit ratings. We have the challenge under the Basel Accords, where Basel Accords allocate zero value to Bitcoin, and now they've announced they're going to reconsider that. So I'm not concerned that we have these kind of concerns. I think we'll educate all of the companies in the space. Ultimately, it's above my pay grade to decide whether MSCI embraces digital asset holders or digital credit or not. It's just like it's above my pay grade whether the S&P 500 puts us in the index. But what I would say is, over the long run, it doesn't matter, because over the long run, this will create near-term volatility. But if the world wants a bank account that pays them 10% rock dividends, and if Bitcoin is digital capital superior to gold, then it's not going to matter what an equity index allocator decides. If the insurance companies don't want to buy Bitcoin and the banks don't want to buy Bitcoin, or the index allocator doesn't want to support a digital treasury company, the free market is going to allocate capital and it will adjust. It just creates a bigger opportunity for some other equity investor that will pile into this particular asset class and support these kind of companies. So it is what it is. It'll work itself out.
Bitcoin is a highly volatile asset that presents both risks and opportunities. As an officer of a publicly traded company, the strategy involves acquiring this volatile asset and mitigating the associated risk and volatility to provide consistent returns to investors who seek lower risk. The volatility of Bitcoin is a fundamental aspect of its overall performance. If it were to become stable, it would diminish its distinctive value and allure. The challenge and opportunity reside in leveraging this volatility rather than fearing it, akin to how innovations such as electric transmissions, combined with fire and automobiles, led to significant advancements. For investors, the investment time horizon and risk appetite are essential considerations. Individuals with funds unused for a minimum of 4 years, pursuing exposure to digital assets without counterparty risk, may contemplate purchasing Bitcoin or related equity holdings. Short-term investors or individuals requiring specific returns should contemplate more conventional, less volatile alternatives such as credit instruments or bank deposits. Despite short-term volatility and downturns, the underlying demand for decentralized, rapid, and sovereign currency persists and is increasingly reinforced by financial regulators and industry advancements. Let us now direct our focus to Tom Lee.
It's been struggling with the same things that it's grappled with all year, which is a monetary policy direction that's not completely clear. As you know, the odds of a December cut have really jumped around from as high as 60 down to 30, back to 80. And the second is, of course, policy volatility, because the administration does make proclamations and statements that are sometimes head fakes but confuse investors, and it's all resulted in really suppressed enthusiasm for stocks. You know, sentiment has been bearish. We just came out of a pretty terrible grind. I've talked to a lot of PMs that have said it's one of their worst 6-week periods ever in their career. So we know people have lost money, they've de-risked. But we know into year end we have the positive seasonals, especially given how strong the May to October was. You know, it's really a 5 to 6 chance that we're going to be up 5% into year end.
Right.
The second is monetary policy, I think, is going to shift dovish. Even if Fed Chair Powell is hawkish, we know it waiting in the wings is now a shadow Fed that's dovish. The third is we know sentiment is going to have to chase this rally because 80% of fund managers are trailing their benchmark. And then I think the fundamental story is pretty intact. You know, as we're doing work into next year, and I think earnings visibility is going to be really good. So I don't think I'm questioning if earnings are peaking. It's more just that stocks price in and correct enough.
Now, you've been, I think, pointing toward, let's say, 7,000 in the S&P by year end. Now, that's only like 2.5% up from here. We made some progress. But a year ago, you also thought we'd hit 7,000 in the first half of this year. So what happened along the way? And I guess, what might you think about in terms of impediments looking into 2026?
Yes, I mean, we're almost through this year. And I'd say, looking back, this was 5 years of history compressed into 1 year, because we had a major bear market, the biggest tariff hikes ever, and that, of course, killed any hope of any 7,000 in the first half. But miraculously, stocks went into a waterfall decline and recovered every single point of that decline symmetrically. So it really speaks to the resilience. But I guess as we're thinking about next year, I bet you it's going to be very similar in the sense that we'll get a policy shock, maybe whether it's monetary or from the administration. It could lead to a big drawdown of 20% again, but it's a replay of this year. And maybe we've now had 3 20% bear markets in 5 years. I mean, that's a lot of history compressed into a 5-year period.
Now,
Tom Lee stated that investor enthusiasm for equities has been notably subdued, with pessimistic sentiment prevailing following a challenging 6-week period that many portfolio managers characterized as one of their most difficult experiences to date. Despite recent setbacks and efforts to mitigate risk, he perceived significant potential for a year-end rally propelled by favorable seasonal patterns, particularly following a robust performance in mid-October. He estimated a 5 or 6 in 10 probability that markets could increase by approximately 5% by the end of the year. Lee also indicated that monetary policy is likely to adopt a more dovish posture. Even if Federal Reserve Chair Powell maintains a cautious approach, as a more accommodating shadow, Federal Reserve is prepared to take action, since approximately 80% of fund managers were underperforming their benchmarks. Lee anticipated that market sentiment would promptly align with any rally. He highlighted that the earnings forecast remained robust for the upcoming year, with stock prices likely reflecting this expectation. Reflecting on the year, he characterized it as a consolidation of 5 years' worth of events, including a significant bear market and the most substantial tariff increases in history, which initially dampened expectations for gains. Stocks declined significantly, but subsequently regained all losses, demonstrating resilience. For the upcoming year, Lee forecasted a comparable pattern, potentially involving an additional 20% decline prompted by either monetary or political disturbances, extending a pattern of 3 such bear markets over the past 5 years. Regarding cryptocurrencies, Lee stated that they strongly mirror risk appetite due to leverage, with the recent market wipeout in 2022 taking approximately 8 weeks for purchasers to re-enter. He believed that cryptocurrencies were approaching a bottom but trailing behind other sectors, particularly artificial intelligence, which he regarded as the market leader. Tom Lee maintained his confidence that Bitcoin could surpass $100,000, potentially attaining new all-time highs, frequently making significant shifts in brief intervals towards the close of the year. He identified AI as the primary long-term catalyst, citing substantial investments, significant growth potential, and persistent shortages in both power and silicon, anticipating it will propel the broader market in the coming year. He minimized valuation concerns, citing research indicating that the most expensive equities at the end of 2015 subsequently delivered the strongest performance over the next 5 years. Considering Bitcoin's inherent volatility and the emphasis on a long-term investment perspective highlighted in recent expert interviews, how do you personally approach risk management and scheduling in your Bitcoin investments? Kindly share your opinions in the comments section below. Please share this video and kindly click the like button. Thank you for your attention. Please remember to subscribe.